Welcome to the DoughRoller Money Podcast. I'm your host, Rob Berger, and today, in episode 210, we're going to evaluate a listener's investment portfolio. I received an email from a listener named Dave. He asked me to take a look at his portfolio, and while he understood I couldn't make any specific investing recommendations, he just kind of wanted me to look it over and maybe point out some things that he should think about, maybe ask some questions, and tell him what I think sort of at a high level. And I thought, well, what a great opportunity to sort of walk through the process of evaluating an existing investment portfolio. So that's what we're going to do today. It's really pretty simple. The tools that I use are free and for the most part, and very easy to use. And so we're going to walk through a real life portfolio and kind of tear it apart, if you will. That's going to be our sort of main topic for today. For the Daily Dough, we're going to be talking about nothing. Well, kind of. You'll see what I mean when we get to the Daily Dough. And then for the last segment of the show, we're going to respond to a listener's email regarding a question that I get a lot. I've talked a little bit about it on the show. It relates to investing, and it's this. For those in their 20s and 30s and with many years to go in terms of an investing horizon, is it okay, acceptable, reasonable to be 100% in stocks? So that's what we're going to do today. So let's get right to it. So let me start with the email that I received. Again, the listener's name is Dave, and he emailed me about his investment portfolio. And here's what he had to say. He said, "Hi, Robert. I understand about the not giving advice thing. Below, I have a screen capture with the firm's name blocked out, meaning I don't know where he has his money invested. I know the mutual funds, we'll look at some of them in a minute, but I don't know what broker he's at." He goes on, he says, "I also blocked out the amount of money, but I am showing the performance up to 5 years to the right. In the skinny box over to the right, you will see that my funds have a 5-year performance annualized average of 0.8%. And above this figure, there is 2%, which is before the firm's annual fee of 1.2%. So in other words, his compound annual growth rate over the last 5 years has been 2%. The firm that invests his money for him charges him 1.2%. That's their investment advisory fee. And so that's left him with a net return over the last 5 years, averaged out, of 0.8%. He says, I'm 60 years old, but I'm in good health. He wants to continue working for at least 5 years, maybe 10. And he says he has a mid six-figure portfolio, and he wanted me to take a look at it. Now, since then, Dave and I have had a lot of email exchanges, and one of the things he asked for was how to get in touch with Vanguard for their investment advisory services. He had already made the decision to leave his current investment advisor, so that was sort of a decision that he made on his own, but he still kind of wanted my thoughts on his portfolio. And he sent me the ticker symbols for all of his investments, and I know what percentages he has in each of them. And so I was able to evaluate his portfolio, and that's what I did. I'm going to walk through kind of how I did it and the results, and I'll just be quite frank about it. I'm not going to pull any punches. It was quite disheartening. And I think, of course, some of you are saying, Rob, you had me at 1.2%. It was disheartening right there. I don't need to know anything else. Maybe, but we're going to walk through it. So how do we do it? How would you evaluate your own investment portfolio? Where would you even begin, right? And so to me, step one is you have to take the portfolio and enter it into some kind of tool that will give you information about the asset allocation, about the fees and expenses of each fund. Certainly, you could research each one separately without a tool and find out the expense ratio of each fund and exactly what it invests in. But that's a lot of work, and I wouldn't recommend it. I would absolutely recommend using some kind of tool. The good news is they're easy to use and they're free. I guess there's 3 of them I can mention off the top. One is Personal Capital. They offer a free financial dashboard. You can link your investment accounts, and it will bring all of them in and give you your asset allocation and your fees. That's the easiest one to use. That's one. Another one is Future Advisor. It's very similar to Personal Capital. I think Personal Capital's financial dashboard covers a lot more things. You can actually manage your budget and everything else with it. Future Advisor is more focused on investing, but it does a similar kind of thing. Now, in both of those cases, you would actually input your username and password to your different investment accounts so that they could go out and bring in all of your data. It doesn't give them the authority to actually, trade your account. That's important. But it allows them to take all that information, bring it into their tools, and then evaluate it for you and then show you the results. Now, of course, I can't do that with Dave's accounts, right? I don't have his username and password, and please don't send me your username and password to anything. I don't want your social security number, your phone number, nothing. Anyway, I don't have that, right? So I use Morningstar. Now, there's pros and cons to Morningstar. The good thing is I think it provides the most data, the most detailed evaluation, whether you're talking about asset allocation or whatever. It really is just a wealth of data. The downside is you have to input it by hand. And then if you're going to update it on a regular basis, you've got to update it manually. So that's sort of a big downside. But for our purposes, it worked just fine. I will say the other thing is you can create a portfolio in Morningstar for free. You have to create an account, but you can create a free account and input your portfolio. But a lot of the tools that they have, like their X-ray tool, which will dive down deep into the asset allocation, is only available for premium members. I do have a premium account, so I can get access to all of that. But that is an additional paid feature. So just kind of keep that in mind. But you certainly can input your portfolio and get a lot of good information from Morningstar for free. So that's what I did. That's what I'm going to use sort of as we work forward in evaluating Dave's portfolio. I use Morningstar. But whatever you use, Personal Capital, Future Advisor, Morningstar, some other tool, I highly recommend the very first thing you do, get a good financial tool that you can input all of your investments in and let it do sort of the hard work of evaluating your asset allocation and your fees. That's step one, and that'll make your job a heck of a lot easier. So once I have Dave's investments in Morningstar, and this would be true evaluating my own portfolio, anyone's, the very first thing I look at is the allocation between stocks and bonds. That is the most important asset allocation decision I think any investor will make. There are certainly others, right? Do you invest in U.S. stocks versus international stocks? Do you invest in just large companies or also small companies, REITs, emerging markets? Do you invest in commodities? There are all these sort of important decisions, but stocks versus bonds is, to me, the most important. Now, in Dave's case, it gets a little tricky. At the end of the day, he has roughly a 50-50 allocation, 50% stocks and 50% bonds. Now, you may say, well, Rob, I don't get it. What's the hesitation here? Well, we'll get into this in a little bit later, but he has one of his funds is a long-short fund, meaning they have some long investments, meaning they're just buying the stock outright. But the mutual fund is also has some short positions. They're shorting stock. And so in Morningstar, it shows you the long positions, which if you add up all of his long positions, right, normally for most of us, we just have regular mutual funds, they'll all add up to 100%. His actually add up to 107. And then he has a -7 for his short positions, which gives him a net of 100. And you might already be guessing one of my comments that I'm going to make about the portfolio. Putting the long-short fund aside for a moment, his stock-bond allocation is roughly 50-50. Now, he said he's 60. He's going to work for at least another 5 years, maybe 10. One of the things you think about when you're getting near retirement is you're going to plan for a certain time period that you're going to be retired. I think as a general rule, folks say if you retire at 65, you should plan for a 30-year retirement. Of course, obviously most people don't live to 95, but unless you have special circumstances, it's better to, I think, assume a longer retirement than a shorter one, right? And then end up outliving it. And so, if you make that assumption here, he's 60, he's still got 35 years. That's a pretty long investment horizon. So one of the questions I would suggest that Dave think about is a 50-50 allocation too conservative? Now, he is 60. He's going to be retiring relatively soon. So I certainly wouldn't recommend 100% stocks, like we're going to get to in the listener question at the end of the show. But I think it's a question. Is 50-50 a little bit too conservative? Now, you may say, well, how do you even begin to answer that question as you get near retirement? So One of the things to think about is when you hit retirement, as you've probably heard, there's this 4% rule of thumb. That is to say, in year one of retirement, you can take out 4% of your nest egg. And then in whatever that amount is, we'll assume $1 million portfolio, that'd be 40 grand. And then in year two, you forget the 4%. That's only for year one. And then what you do is you take whatever amount it is you took out, whatever that 4% equaled in our hypothetical $40,000, and in year two, you increase that amount by the rate of inflation. And you take out whatever that might be, $40,500 or $40,800, whatever the inflation was that year. And each year you ratchet up the dollar amount you take out of your nest egg by whatever the inflation rate was that year. That's sort of a general rule of thumb. And the question becomes, all right, well, if you follow the 4% rule, what are the odds that you'll outlive your money, which would not be good, right? Or that the money will outlive you. In other words, what are the odds that you'll run out of money? Well, a lot of folks use Monte Carlo simulators and other types of simulations to run a whole bunch of different stock possibilities or market possibilities. We don't know what the market's going to do, but we can take history and we can put this through a computer algorithm, and we can calculate based on historical data the odds that you'll have enough money in retirement. And of course, you might say, well, that would depend on your asset allocation, right? That's right, it would. And so at a 50-50 allocation, you have about an 85% success rate if you use the 4% rule. If you get too conservative, say you had 20% stocks and 80% bonds when you started your retirement, then you probably couldn't take out 4% in year one and still have an 85% chance of success. Now, you might say, okay, well, how do you put all these pieces together? Well, there's a great article. It's written by Maria Bruno, who's with Vanguard. I actually had her on the show, and a link to that article, and then a link to the interview with her, if you missed it, because this was, goodness, I don't know, a year or two ago. I can't even remember how long ago it was. Are going to be in the show notes, which you'll have in the you'll see on the blog, or if you get the newsletter, DoughRoller.net/newsletter, it'll be in next week's newsletter. So I highly recommend that, and I'll also post it in the Facebook group. So if you're not a member of the Facebook group, you need to join it, DoughRoller.net/Facebook group. I'll put it in there as well. But that's how I would think about the proper stock bond allocation once you retire. Again, Dave's at least 5 years away from retiring, so he might even take on a little bit more risk. If he works with Vanguard, as I think he's going to, they'll help walk through that very important decision. So anyway, step 2, evaluate your stock bond allocation. It's the most important allocation decision that you'll make. And again, as you hit retirement, a lot of it is going to depend on how much you want to withdraw from your account, as well as your risk tolerance and other things like that, your other sources of retirement income, and so forth and so on. So that's step 2. He's at 50-50. Again, I think one question I would have raised here is that a little too conservative, given he's still got 5 to 10 years before he retires, and a potential retirement span of whatever, 25, 30 years. That would be a question that I would ask. Now, the next question then, step 3, if you will, is to evaluate. We've looked at the stock bond allocation. You've set it wherever you think it's appropriate, or if you have investment advice, worked with your advisor and you've worked with him or her and come up with a good stock bond allocation. Now it's to evaluate the actual stock allocation part of that equation. And here, I had a lot of questions with Dave's portfolio, a lot of questions. And by the way, you'll see the portfolio in the show notes, but I'm going to kind of walk through some of it for you. The first is his advisor has him in about 9% of his portfolio in gold, a commodity. I don't. My first question would be why? Why up 8, 9, 10% in gold? It doesn't generate any income. Historically, returns on gold have not been great. I know there are gold fanatics, And they say, it's perfect for when the world comes to an end, or, when inflation is sky high. And there are even some that get a little more academic on you and say, well, if you test portfolios, it'll show you won't increase your volatility, and you'll get the same return or maybe a tad better with commodities or, with precious metals. I understand that argument. I still, again, this is my take on his portfolio. I don't get the point of nearly 10% in gold. That's the first thing. Now, the second thing is, it may surprise you to know that in Dave's portfolio, he has 3 individual stocks. He actually owns shares of American Express, he owns shares of Boeing, and he owns shares of Caterpillar. Now, I have no complaints about any of those investments in and of themselves. It all adds up to roughly 8 or 9% of his portfolio. 4, 5, 6, 7, 8. Yeah, about 8.5% of his portfolio. I just don't understand the purpose of that. I mean, I own individual stocks, so I'm not really complaining that he has individual stocks. He doesn't own an S&P 500 index fund or total stock market kind of fund. It's almost as if a lot of his large cap exposure comes from these 3 companies. And I just don't understand that. That would be a question I would ask. What's the reasoning behind that? Maybe there's a good answer, but that would be a question. Next question is on the international side, and if we break out again, Morningstar gives us all of this, but he has, in terms of U.S. stocks versus foreign stocks, it's 39% U.S. stocks, 15% foreign stocks. Now, I take no issue with that. Again, I think you could certainly justify other allocations between U.S. and foreign stocks, but that's fine. I have no qualms with that, except the vast majority of his foreign stocks are all in North America. So I guess mainly Canada, but also Mexico. I mean, if you look at say Europe, it's a very small percentage. None in European emerging, 1% in Japan, Asia almost none, very small amount. So there's almost no diversification on the international front. At first blush, it looks like, he's well diversified. He's got 15% of his portfolio in foreign stocks, but when you use a tool like Morningstar and you dig into the details, you realize, no, 87.6% of his stock exposure is in North America. So that would be a question. What's the rationale for that? And again, maybe there's a good one. I don't know, but I'm sort of evaluating the portfolio. That would be a question I'd be asking. And then we mentioned the long-short fund. I kind of described for you briefly what it is, where a fund manager will not only buy stocks, which is meaning you own them long, they call it, right? It's just your typical, you own shares. You go out and buy Berkshire Hathaway shares, you're long on Berkshire Hathaway. But if you're going to short some stocks, that is to say you think the price of the stock is going to go down, right? So you're going to effectively borrow them now and buy them back at a lower price and make some money. And he owns a long-short equity fund, and I don't understand. I don't understand why. What's the purpose of that in this kind of portfolio as someone's nearing retirement? Is that really necessary, particularly when it has an expense ratio of 1.53%? Now, I haven't gotten to fees yet. That's coming down in just a minute. But really, we need a long-short fund? I don't understand that. So that would be another question. And then another question would be, he's got about 15% roughly in small cap fund. I think small caps are great. I own a Vanguard value small cap fund, but particularly when I'm looking at a portfolio with really no large cap funds, just a few individual stocks that I guess would classify as large cap. It's odd to me that there's this great exposure to small cap funds. That doesn't make a whole lot of sense to me, and so I'd kind of want to understand that. In fact, if you add both his small cap and mid cap exposure, he's got nearly 35% of his equities in small caps and 30% in mid caps. And then again, this sort of smattering of odd collection of 3 individual stocks. Don't understand that. So from the stock evaluation perspective, would want to understand that better. Now, of course, one question might be, well, what's the alternative? Well, again, there's many alternatives. There's many ways to get what I think to be really good exposure to equities, to stocks. Now, again, I'm not making any recommendations for Dave. I think he's going to reach out to Vanguard. They'll do that. But just speaking generically, one would be the Vanguard Total World Stock Index Fund. There you just get the whole kit and caboodle in one fund. That's both domestic U.S. companies and foreign. Boom, one and done. That's one way to do it, right? You could, if you wanted to maybe break it out into two funds, you could use the Vanguard Total Stock Market Index Fund, which is a U.S.-based, U.S. company fund for your U.S. exposure, stock exposure, and the Vanguard Total International Stock Index Fund for your international stocks. That'd be another way to do it. You could add a Vanguard value small cap fund. I do that at 10%, just to tilt the exposure a little bit to the small cap side. You could, on the international side, add, say, 10% to Vanguard's emerging market fund. I do that as well, just to tilt things a little bit more to emerging markets. But keep in mind, when you do a Vanguard Total Stock Market Index Fund or a Vanguard Total International Stock Index Fund, in the U.S. fund, you're getting small cap, right? So when I put extra money in a small cap fund, I'm just getting a little bit more exposure. On the International Stock Index Fund, you're getting emerging market exposure. It's just that when I put 10% in a separate emerging market fund, I'm getting just a little bit more exposure. And the theory is, yes, these are volatile funds. They're going to go up and down in value because of the nature of the investments. But over the long term, they tend to outperform a little bit. And since the portfolio as a whole is well diversified, you can handle having funds here and there that by themselves are very, very volatile. Because when you look at your portfolio as a whole, it won't be as volatile, if that makes sense. So the point is, there's a lot of ways to get great stock allocation. And by the way, I've just mentioned Vanguard. Fidelity has virtually the identical funds. Fidelity would be another great option. Obviously, you could use a robo-advisor if you wanted to go that way, like Betterment or Wealthfront. But very easy to get what I think are very, very sound stock allocations. With Dave's portfolio, a lot of questions that I'm not following. I'm not tracking what the thinking is from his advisor. Again, maybe there's great answers. I don't know. But those are sort of the questions I would have for the stock allocation. Okay, step 4, the bond allocation. Now, to me, bond allocation is pretty easy. I just want to, again, I've just used Vanguard. You could use Fidelity, whatever. But your Vanguard Total Bond Fund, it kind of gives you a little bit of everything. And, it's simple. And I use an intermediate term fund. So I have some exposure to interest rate risk, but it's not huge. By the way, if you don't follow that, all I mean is with a bond, with existing bonds, if interest rates go up, the value of the bond goes down, right? I've explained this before, but let's say you have a bond that pays 2%, and then interest rates just go sky high, they jump to 5%. And you're thinking, man, I've got this money locked in this bond at 2%. I'd love to be able to, ditch this bond and go buy the one that's now paying 5%. They're basically the same, but I can't do that. I could try to sell the 2% bond, but who's going to buy it, right? Why would they buy my bond when they can go out and get a brand new one at 5%? And you're right, they wouldn't. So what would you do if you wanted to sell it? You'd have to discount it, right? You have to lower the price and sell it at a discount in order to get someone to buy it. And the discount would have to be enough so that they would effectively get the 5% they could get in a new bond. So anyway, if you have a long-term bond, that is to say it doesn't mature for many, many years, let's say 20 or 30 years, well, you have a lot of interest rate risk, right? But if your bond, just use an extreme example, if your bond were going to mature tomorrow, that's not much interest rate risk at all. Even if the interest rates went up to 20% today, that's okay. It matures tomorrow and you can go reinvest. So I kind of just split the difference and I go with an intermediate term bond fund. And it's pretty easy to do. You could also, I think, justify just a U.S. government bond fund. Because remember, the purpose of bonds is honestly, it's not to make a lot of money. It's to give a little stability to your portfolio. Now, in Dave's case, his primary bond allocation, or a big chunk of it, is a high-yield bond fund. Like 20% is in a high-yield bond fund, which is, another word for high yield is junk bond fund. What that is are companies that issue bonds and their credit rating is below investment grade. Now, that doesn't mean it's a bad investment. And in fact, the yield you get is higher, right? Because people say, look, companies that are below investment grade present higher risk, so I'm going to demand a higher return to make this investment. So the yields are higher. But at that point, I question whether the bond is serving the purpose that I think for most portfolios, it's designed to. I don't want to take risk in my bond portfolio, right? I can just invest that money in equities. If for my bond portfolio, I want a little bit of security, and I'm not going to get that from a high yield fund. So that would be my big question for Dave and his advisor. Why, particularly as you're nearing retirement, why 20% in a high yield bond fund? That just doesn't make sense to me. Again, they may have a great explanation. I don't know, but that would be a question that I would ask. And so again, very easy to do a bond allocation, I think, and very easy to evaluate. By the way, if you put your investments in Morningstar, it'll tell you your interest rate risk, whether your bonds are long term or short term. It'll also tell you the credit risk, that is the risk that the company or government that's issued the bond is going to default, right? So for the U.S. government bond, it's sort of deemed to be almost riskless. The chance of default is nil. I guess you can make your own assessment as to whether that's how valid that is, but that's sort of the working assumption. And if you own bonds issued by Brazil, then maybe your risk is quite high, or maybe a company that's struggling. So, but in Dave's case, again, high yield bonds, I would want to understand why. That's a question that I think Dave ought to be asking. So we've looked at the stock bond allocation. We've sort of gone into the details on the stock side and asked some questions. We've gone into the details on the bond side and asked some questions. And then the next step 5, is to actually evaluate some specific funds and to ask why these funds. If we've set our asset allocation, we know what we want, it's time to pick funds. Why have the funds that are in Dave's portfolio, why did his advisor pick those? And part of this, I really kind of break this question into 2 related questions. The first is it an index fund or an actively managed fund? And if it's an actively managed fund, why? Why is an index fund not good enough? What's the benefit you're getting from an actively managed fund? I don't rule out actively managed funds. I own 1 or 2. But I do think that the burden of proof is on the actively managed fund. Why are you putting me in this fund versus an index fund that covers the same asset class I'm trying to get exposure to? That's question 1. And then question 2 would be the fees, right? Why these fees? Are they too high, too low? If you're dealing with an index fund, usually the fees are quite good, although not always. Don't assume because it's an index fund, the fees are fine. They may not be. But if it's an actively managed fund, then you really, really have to look at the fees. And so when I go down and look at his funds, and I know obviously as you're listening to this, you don't know what they all are, I'll have them in the show notes. Some of them seem fine. There's an iShares 20-plus year Treasury bond, 15 basis points. 20 years seems a bit long. I don't know what the thinking is there, but all right, that's fine. But some of them are interesting. He's got a real estate fund from Ridex, 1.6% expense ratio. He has a utilities fund, same Ridex utilities fund, 1.35% expense ratio. The long short fund we talked about, 1.53%. In fact, with the exception of some treasury and sort of basically savings account type funds, all of his funds are quite expensive. Invesco Dividend Income, 1.12%. He has a small cap value fund, 1.15%. Fidelity Select Transportation. Why does he even have that? And it's 81 basis points. Seems kind of high. The gold fund we talked about, 92 basis points. 92 basis points to stick your money in a gold fund. When you average it all out, his expense ratio comes to 72 basis points. And that's even when you factor in the 3 individual stocks he owns, which of course don't have expense ratios. And it includes a pretty substantial amount in cash or cash equivalent type funds. And you still have an expense ratio of 72 basis points. So what comes from this? The questions I would be asking is, 1, why do we have these actively managed expensive funds. Why do you think, Mr. or Mrs. Advisor, that these are better than a low-cost index fund? And can you show me? Let's look at historical data if you want. We know that the future doesn't repeat history. It may rhyme, but it doesn't repeat. So fine, but what's the justification for this? That's the question that should be asked. And when you add the 72 basis points for the expense ratio to the 1.2% investment advisor fee, you're now at just under 2%. There's simply no way in my mind I could ever see this portfolio outperforming on an after-fee, after-tax basis, even a 3-fund portfolio, index portfolio from Fidelity or Vanguard that would be much easier to manage, much less expensive. I just, given this almost 2% headwind, I just can't see it. I can't see it happening. And so those would be my questions as we look at specific funds and the expenses with respect to those funds. Now, one other thing, and this is so critically important, and it's something that I didn't see at first when I was looking at his investments, but he has about, I say roughly, and let me see if I can actually pull it up specifically. It's roughly 20%. Yeah, he has over 20% in cash, right? Now, that may be correct in terms of an allocation because, actually, I should stop myself. No, I don't think it is correct, right? He's 60. He says he's going to work for at least 5, maybe 10 years. Why in the world is 20+% of his portfolio in cash? That's a question that needs to be asked. Now, again, I suppose there's a good reason for it. I don't know. I can't think of one, but that's the first question that should be asked. The second one, though, is this. Am I really paying an advisor 1.2% of my cash balance? Imagine $1 million portfolio with 20% in cash, $200,000, and I'm paying 1.2% of that $200,000 for an investment advisor to hold my money in cash and cash equivalents. That's crazy. And so even if there should be that much in cash, it probably shouldn't. Well, none of it should we be paying someone 1.2%, in my opinion. But if you're going to, why pay them 1.2% to keep a big portion of your portfolio in cash? That doesn't make any sense to me at all. And in fact, John Bogle, founder of Vanguard, has written a great article about this, about the sort of hidden fees of actively managed funds. One of them is what he calls the cash drag. And his point is that a lot of actively managed funds can, from time to time, hold a lot of the money in cash. And there may be good reasons from their perspective. Maybe they're waiting for great investments and there are none available, the market's too rich or whatever. But you're paying a big expense ratio on this actively managed fund. And to have a lot of that fund sitting in cash, you're going to pay more than you're earning. You're going to be losing money on your cash. So that's a big problem. And it's a problem that I see here in this portfolio. So kind of walk through it. It may be a little hard to listen, not actually see the funds and see the information. As I said, you can check out the show notes and I'll have all of the information there. But to me, the biggest thing, probably even more so than the specific allocations, many of which I just don't understand, like the exposure to gold, the exposure to long short, the lack of diversification in the international stocks, the ownership of 3 individual stocks. I think a lot of questions there need to be asked. But also when you then add to that a large portion of cash, all being hit with a 1.2% management fee on top of a average weighted expense ratio of 72 basis points, I think adds up to a lot of questions that again, he's going to reach out to Vanguard, and I have no doubt that Vanguard is going to approach his investments very differently. And Dave, I wish you the best of luck with that. One of the things to keep in mind, too, when you add his expense ratios with a management fee, it's 1.92%. One way to think about that is to fast forward to retirement. You can take out 4% a year, right? That's year one, 4%. You got to give 1.9% of that to your investment advisor and the managers of all these funds they've put you in, leaving you with just over 2% to actually spend on retirement. That puts 1.92% total expenses into perspective real quick. And by the way, those expenses, they don't include transaction costs, right? Because those aren't included in a funds expense ratio. They also don't include the tax consequences of actively managed funds if any of these investments happen to be in a taxable account. Well, there you go. That's sort of my walkthrough of this portfolio. If you want me to maybe on a future show sort of walk through your portfolio, again, I will not give specific investment advice, but I'm happy to, why not? Maybe it'll be a regular part of the show. I'm happy to, look at portfolios and sort of ask questions. Here are the questions I would ask, kind of thing. And I don't know if I'm going to get inundated now with emails. Maybe that's okay. But happy to maybe do that from time to time, or again, maybe it's a condensed version of this. Who knows? Maybe it'll become a regular part of the show. But happy to at least hear from you. But again, keep in mind, I'm not going to be giving you specific investment advice. It's just not what I do. You need to go to a qualified investment advisor, maybe even someone at Vanguard, for example, if that is what you're looking for. Okay, now on to the daily dough. I told you the daily dough is about nothing. Here's what I mean. So we have a garage, and I've gotten kind of crazy about keeping the garage as neat and clutter-free as possible. I want to actually get it painted. I want one of those garages where the floor is painted, and I want nothing sitting on the floor, maybe a shelf or two against one wall, and I just want it bare. I don't want anything in there, nothing. Yeah, I know that's probably a little extreme. We're not quite there yet, but it's in pretty good shape. And there's one wall of the garage. It's, when you walk out of our house into the garage, there's this, wall, a side wall. I don't want anything on that wall. Nothing. That's where we walk. Whether we're walking out the garage or getting in the car, I don't want anything hitting the cars. I want nothing on this wall. Well, it's been a real battle. It's like my family just can't handle the fact that there's a wall with nothing there. It's like, Dad, there's space here. We've got to put something there. We can't just have nothing. So finally, I said to my son, who seems to be the problem here, I said, okay, here's what we're going to do, bud. Look at this. I'm going to give you a cabinet, and it's going to be your cabinet. No one else can use it. And it's in the garage. Here it is. Isn't it nice looking? Big cabinet. Man, put whatever you want in that cabinet. As long as the doors can shut, it's all yours. Man, fill it up. But don't put anything along this pretty, pristine, empty wall. Nothing here. Nothing anywhere in the garage except the cabinet. But man, the cabinet is all yours. So, of course, immediately the cabinet is just stuffed full of stuff. Fine. That was the deal. Good. It takes about a week. And sure enough, I'll walk out one day and there's stuff on the wall. Drives me crazy. And so then it's another conversation. Son, remember that cabinet I gave you? Yeah, Dad, it's great. Yeah, that's terrific. Glad you like it. Why is there stuff on the wall? Well, why can't I put something there? It drives. It's just yeah. So I get it in the scheme of things, ain't that big a deal, but it drives me crazy. So we have another conversation and we get rid of the stuff that's on the wall, and I kind of have to police this wall to keep it empty. I want nothing there. And I started thinking, we do that with our lives, don't we? It doesn't matter, we fill up our houses with stuff, we fill up our time with stuff, and we spend our money with stuff or on stuff. It's like we can't help ourselves. If there's an empty space, it's got to be filled. If there's an afternoon free, we got to just fill up with things to do, right? If we have money in the checking account, it's got to be spent. And I see this with like my mom and with my in-laws. We're already sort of working on decluttering their homes. At some point, they'll probably move, and it's a chore. It's a huge undertaking to get to deal with the stuff that has accumulated over a lifetime. And I get that. We have stuff in our house. Frankly, if it were totally up to me, we would have decluttered a lot of the stuff. And I can't say that I'm not the culprit in some instances. Surely I am. But it just kind of hit me how. What doesn't matter. If it's money in the bank, we want to spend it. If it's free space in our home, we want to fill it up. If it's our time, somehow, we want to use it. Or if someone says, hey, do you have time on Friday to help me? If there's nothing actually scheduled, the answer is always yes. And I started to think, really what we need to do, we need to make sure that we fill in the important stuff first. You talk about money. We've talked about this, pay yourself first. It's really an important concept. Get your money in and get it to the right place quickly. If it's going to go to a 401k, it's usually going to come right out of your paycheck and it gets to the 401k and you never see it. That's perfect. But if you're saving in an emergency fund, get it out of your checking account immediately. In fact, try to have it just go right from the direct deposit to the savings account if you can, or if it goes to your checking account, move it to the savings account immediately, or move it into the IRA if that's where it's going, or if it's going to a taxable account at Fidelity or at Betterment or wherever, get it there right away. Put it to its highest and best use immediately. Don't let it just sit there. Or maybe you're paying down debt, fine. As soon as you get that money, put it on the mortgage or put it on the credit card debt or the school loan or the car loan or whatever you're doing. Get it to where it needs to go immediately so that bad things don't happen to that money. The same thing is true, I think, with our time. I've really made a concerted effort to fill up my week. And what I mean by that is I don't necessarily mean with appointments and phone calls and things to do 24/7. A lot of times I fill up my week with free time. Or if I'm going to be writing an article for Forbes and I think it's going to take me 2 hours, I might schedule 4 hours, right? So and I view that tired time as I'm busy now. So if someone says, "Hey, can you do something that afternoon?" and I've got my Forbes article scheduled already, the answer is no, I can't. I mean, if it were an emergency, obviously I'd make a change, but barring that, no, I can't. I'm busy that 4 hours, even though I know it might not take me the full 4 hours to write the Forbes article, or in this case, to record a podcast or whatever it might be. But it gives me control over my time rather than having the time control me. Now, in the case of the empty space in the home, that's a tough one. Maybe I should fill it up with something that blocks people from putting other stuff in my garage. I don't want that. I want it empty. I want it neat and clean. So I guess I'm just going to have to keep policing that. But if anyone has any suggestions, I'd love to hear them. But I thought I'd share that with you. I think it's something important to think about when it comes to our time and our money. Because if we don't take control of these things and allocate our time and our money to the right things first, oftentimes we'll find that we've allocated our time and our money to things other than their highest and best use. All right, on to our question of the week. It comes from a listener named Martin. Martin writes in and says, "Hi, Rob. My initial thought for writing was just to thank you for doing such a good job on your blog and podcast. It is really informative, and the podcasts are nice and easy to listen to." I like that. Good. All right. On the fly, I thought, though, about a question. Here it goes. What are the reasons a rather young investor, 28 years old, with a 15-plus years planned investing horizon should currently include any bonds in their portfolio? Now, let me just stop there. My first question right now is, if you're 28, why is it just 15 plus years? Shouldn't it be more like, 50 plus years? Anyway, Martin continues. He says, "My current strategy is to regularly pour money into Vanguard All-World Fund. I'm not entirely convinced that I should have any bonds in my portfolio. And here's my reasons for this. Number one," he says, "bonds usually keep their value better during stock market down periods and offer the possibility to sell bonds and buy stocks at low prices. That would be the argument to have bonds in your portfolio." But he responds and says, "But don't the dividend payments I receive offer the same means for buying stocks when there are down periods for stocks? Also, aren't we currently on the verge of interest rate upward cycle where bonds depreciate in value and there's a great possibility for real returns of bonds will be negative for the next 20 or 30 years?" And then the next argument in favor of bonds are they help keep the volatility of the portfolio down and keep you on track. And his response to that is, well, why not gather sufficient amount in cash, like in a bank, let's say at least the value of 1 year's expenditures. When the time comes to rely on your portfolio for income, you can both use the dividends you receive as well as the money from deposits, should there be a need for it. Can you give me your 2 cents on why this would be a bad strategy? Well, I can give you my 2 cents, and I promise they'll be worth every penny. So for young folks, say in their 20s and 30s that have a long investment horizon, I think you can absolutely justify a 100% stock portfolio. Yep, you can. Now, it means you're going to have to weather a storm. You're going to have to be willing to lose 50% of your portfolio, or I shouldn't say lose, but you have to be prepared for your portfolio to go down by at least 50%. Obviously, it could go down more, right? But I would say just sort of a rough rule of thumb, take your all-stock portfolio. Let's say you've got 100,000. Now imagine it being worth 50. How do you feel? Are you going to stick to a 100% stock portfolio? Now, if you're young, maybe the answer is yes. And if you are, I think you can justify a 100% stock portfolio. But one of the things that Martin mentions, it's the second point about, why not have a year's worth of expenses in a savings account? That is a critical point. And it's this. Your allocation, particularly stocks versus bonds, you have to look at your finances as a whole. If someone came to me and said, I've got 6 months expenses saved in the bank account, I have no debt, and I'm 30, and I've got 100% stock portfolio, and I've got a good job, and it's in an industry where even if I lost my job, I could probably get another one pretty easily. I'm a computer programmer, or I'm an engineer, or whatever, a school teacher, and jobs are plentiful, whatever. That's one thing. And you say, yeah, if you're comfortable with that risk, that makes a lot of sense. On the other hand, if you said, I'm 100% stocks, I've got no money in the bank, I've got school loans and credit card debt and a car loan, and I'm barely getting by month to month, I would say it's probably going to be hard for you to really stick to that kind of 100% stock portfolio, because the other areas of your finances are risky as well. So I think Martin makes a great point when you look at your investments. Yes, you analyze them by themselves, but I think you also need to look at them in the context of your finances as a whole. And I think even for me, I'm a tad older than Martin. I'll be 50 this year, which of course means I get to put more away in the 401k. I'm obviously older, but we don't have debt. And so we've got emergency fund saved, so I can feel comfortable taking probably more risk than someone else who's 50 that maybe doesn't have that. So you absolutely want to look at your finances as a whole as you set your asset allocation. By the way, the same would be true when you're retiring, right? Do you presumably, not everyone, but presumably have Social Security? Do you have a pension? Do you have other sources of income? These are important questions and things to consider as part of your deciding on your overall asset allocation as you enter retirement. So it's not just about the investments. You need to look at all of your finances. But Martin, to answer your question, yeah, I think it's certainly a reasonable approach to investing to have 100% of your portfolio in stocks at such a young age. I'm not recommending that to anyone. That's a decision you have to make on your own, evaluating your own financial situation, your own tolerance for risk. That's one of the benefits, though, of starting so young. When you start out, you don't have a lot to invest. You're putting $100 away a month, or $500 a month, or $1,000, or whatever you've got, and you're sort of learning as you go. It's not as if you've got $1 million on the line, and of course you don't want to lose it. But you start, as you get that experience under your belt, and you learn more and more. And then you go through a down market, that experience helps you. It helps you understand who you are, your tolerance for risk, whether you can really handle a 100% stock portfolio. One of the things that I've often thought about is, the difference between, say, a 100% stock portfolio and, say, one that's 90-10 or 80-20. If you're 80-20 and we go through another 2008, you're still going to lose your shirt. You're going to lose a truckload of money, or the value of your portfolio is going to go down a lot. You won't actually lose it, right? If you are long term, I think things will come back as they did. But don't think that 100 is this whole risky, horrible potential mess that you could create. But at 80-20, then I'm all good and safe. No, you'll lose. I don't know what it was in 08, but I'm going to guess you still lost 40% of your portfolio at 80-20, maybe more. So you're still losing big at 80-20. And again, I'm not suggesting that those at 80-20 should run off and put 100% in stocks. I personally like to see some money in bonds. I think it's if I were doing a portfolio for my children, which I am, I have some money in bonds for them, and they're in their 20s. But yeah, you could justify 100% stock portfolio, in my opinion. So there you go. Hey. Hope you enjoyed the show. If you have any questions, dr@DoughRoller.net, or better yet, join the Facebook group, DoughRoller.net/Facebook group, and ask your questions there. I guarantee you'll get some great responses from the group. They are terrific. Hope you have a great day and a great week. Until next time, remember, the best thing money can buy is financial freedom.